Welcome to Power Charting. I am your host, Bruce Frazier. Let's get started. We have not gotten together since the middle of December. I hope you had a fantastic holiday season and a very happy new year. And we want to get 2024 started off with a bang. The way to do that best is I have a request and a homework assignment for you, which is to go back and rewatch or watch for the first time the power charting episode recorded on December 13th. I really think this was an important episode, but coming at the end of the year, people are busy. They have a lot of other conflicts, things going on, and there is just a lot here. For those of you that have watched in the past, go back, open up the YouTube, and then just review the charts. Have a look at those because I think that they speak really a lot for how 2024 could unfold, at least initially. We will then get into today some new concepts, some new information, a couple of announcements before we get started. And that is that Wyckoff Analytics is starting their new cycle in 2024. Very cool thing that Roman and his team are doing is on January 5th, they're doing a Charting Essentials technical primer. And this is a free event, free to attend. And so please go check that out, register right at the wyckoffanalytics.com homepage. And then Roman starts his new teaching cycle, part one of the Wyckoff trading course, which is very much patterned after the class that we taught at Golden Gate University, except I think it might even be better. So Roman does an incredible job. And then Joe Turner and I, starting on February 1st, are going to do a series on trading through the business cycle, part two. And this is going to be how to conduct your investment and trading campaigns in the new inflation era. We will talk all about that, talk about tools, techniques, strategy, etc. And we're working on it now, and it's going to be really, really good. So I hope you'll consider it. Go check it out here at the Wyckoff Analytics page. Now, let's start with a review of 2023 from a seasonality perspective. You know, we've been using this chart all year long, and we started off the year talking about how we were going to have really good seasonality in 23 going into May. And in fact, the best part of the year was really into May and then into July, range bound or down into October, November, and then strength into the end of the year. Well, you've looked at this chart repeatedly if you've been following power charting through the year, but this is how it turned out, and it's been fantastic. It's worked out so well. And so you can see here that we had really good strength in January, and then a good trend into June, July, end of the second quarter, and then a correction into October. And almost to the day, the low that was made in the seasonality matched the low made in the S&P 500. And then fourth quarter strength, and the fourth quarter strength was exceptional. It was a very good close to the year. We have talked so much about seasonality and window dressing and the effects of quarter ends and quarters, and the fourth quarter really was strong and really put institutions at a tremendous disadvantage because this was really dominated by the mega caps, as we've talked about over and over and over again, and that the mega caps closed the year on the highs. But this came with a warning, and we have talked about this for the last few months, is with the mega caps closing on the highs for the year, it would create tremendous really mismatch of performance by the institutions to what the indexes have done, because the indexes are so purely capitalization weighted. So here we can see that just looking at a pure cap weighted index, the S&P 500 or the NASDAQ 100, that just ripped all year long, way outperformed what most portfolio managers have been able to do. And they did window dressing into the end of the year. And this window dressing, I think, puts them at a distinct disadvantage. They did not want to sell their biggest winners until the new year, but we talked about how they have no choice but to sell down their owned mega cap names, large cap stocks, which appreciated the most. They have to get down their allocations to prior levels or possibly even lower. And that we said that they would likely wait until the new year and maybe even buy mega caps, big cap stocks as the year ended, which was, I believe, a mistake, and they are going to pay for it. This is the first 2 days of 2024. You looking at the market carpet, the heat map, you can see this at stockcharts.com. It's such a cool tool. Dark red is the most down, dark green is the most up, and you can see here, looking at the really big blocks on this market carpet for the first 2 days, that it is turning out kind of as we worried about, which is that we got into the new year, new year for tax purposes, and selling has started. And selling, look at the dark red in the biggest blocks, and all the big blocks are red, either light red or deep red. And as you can see, for the first 2 days, now this is only 2 days of data, but it gives us a clue about how these institutions have been behaving here as the new year has started. More on this in a minute. But note, healthcare has got a lot of green in it. Also notice that consumer staples has mostly green in it, and that's been a laggard group. Energy has been a laggard group. Look at the green that's shown up here. And utilities has been, somewhat of a laggard. And then you can see, this is not good. Look at all the red that's in the industrial sector. This could be a reflection of the economy, and that the economy maybe isn't all that strong. So anyway, more on that in the weeks ahead, but do watch the market carpet. Look at where the green and the red is. You can look at different time frames. Here's the first 2 days, and it's turning out as we were concerned. So moving ahead, this is a chart we've looked at many, many times. This is the NASDAQ 100 daily bars going back to the bull market peak of 2021. And you can see here this yellow shaded area that we're in is where resistance is, because this is where the top was going back to 21. But also make a note that with all of this incredible performance that we've had in the NASDAQ 100, and look at this high right into the end of 2023, that all that's managed to happen in these NASDAQ names is that they've recovered what they lost off the bull market peak. So this is just a return to where they were in 2021. And look at all the energy that was exerted to get there. Big, beautiful basing structure. There is count that takes the market up to higher highs, but we wonder if there isn't going to be time needed to build a new cause to go higher. Time will tell. The other thing is, note, if we look at stocks above their 50-day moving average on the NASDAQ 100, we got up to over 90, extremely overbought. And so what we look for when we get overbought is a combination of overbought and then a change in directionality in the indicator. This is stocks above the 50. Also note that on the stocks above the 200, which is a little slower, a little more stayed in its trends, but that's good, because look at how when you get trend direction in this indicator, how much it coincides with big moves in the index itself. So as we see here that we are overbought on the 200 and the 50, and that if they start to turn down in earnest in from a resistance area as defined by this yellow shaded zone up here, which is the 2021 highs, we may have to do some range bound work. And at the end of this episode, I'm going to talk a little bit about what 2024 could look like going forward. So stick with me on that. Now, this is a chart that I showed you in the middle of December 13th, when I recorded that episode. I added one more count here just so that you could see, because look at this hinge. Look at this beautiful hinge here. And this is in 2022. This, let me just to explain, this is a relative strength chart. And it is so interesting. I did a lot of relative strength work in that mid-December episode. And so at least go look at those charts. But when the point figure is rising, or a vertical chart, either way, when you do relative strength, that means the numerator, SPY, is outperforming. So we see here in 2023 that the SPY, which is the S&P ETF, was in an upward stride against bonds, which had for the most of the year, were pretty lousy in their performance. Now, note, and also the cause was built. Look at these structures that we have that made these beautiful counts up to these intermediate term peaks. Then we get this big count here, counts up 525.08, another count here that counts 524, 500. These are equaling each other, meaning that this is a reaccumulation count. And right at the level where these counts are fulfilled at 525, beautiful hit on these counts, you have a distribution structure. Now, this is a relative strength distribution. So the question that gets asked is, what if this reverses into a downward trend? Well, could bonds outperform in the first part of 2024? That's the big question to ask. It might be that we want it to be in bonds for outperformance, not in stocks. That we might want to take a break from stocks. More on that at the end of the program. But note here that we take account. We have a count, and it takes us 405 to 390. Now that is a relative strength count, meaning that if this count gets fulfilled, that means that from here all the way down to here, that bonds are outperforming stocks as measured by the S&P ETF. And if that is the case, then allocation wise, we want to think about stocks, think about bonds as a tactical asset versus stocks as the new year begins. I've updated this chart, which I did on December 7th. I updated it here through January 3rd when I'm recording this, and you can see that we made another new low here to 472. I think we were around 488 when I showed this chart. And so 472, don't hold me to that. I'm not sure what the price was at that time. Well, I can tell you up here. Yeah, it was at 478. So downward we go, another new low. We may have to spend time consolidating at this level, but this count maybe even could be bigger. But for now, we have to ask the question, are bonds, especially now that they have yield, a tactical asset that we should consider owning, at least on a trading basis, for some period in 2024. Okay, moving on. Oh, I have a great intermediate trend tool for you. And this is one of my favorites, been using it for many, many years. I don't believe I've ever shown this before. It's a very simple indicator. This is the advanced decline oscillator. And I'm going to show you a 10-day here pretty soon, but this is a 30-day advanced decline oscillator. And so it moves slowly, much more slowly than the 10-day from oversold to overbought and back again. And you can see here that the whole key to this indicator is to look at what direction it's going. And it doesn't always perfectly coincide with the lows and the highs, like the 10-day does a much better job of that. But what we look for is we look for trend. And when the trend is up, we want to focus on the upward trend of the index we're looking at. This is the NASDAQ comp. This is the AD of the NASDAQ comp. And you can see the upward stride, and the upward stride in the indicator coincides with the upward stride in the index. Pretty cool. And then as we get overbought and we get a downward directionality here, that is a period when we want to be very cautious, defensive, and consider that the trend is down to sideways to down for the near-term future. I put the RSI up here just so you could see it. There's a little bit of a divergence taking place at the highs right here, just so you can see that. But look, late October low, right when the seasonality turned positive, upward goes the trend of the index, upward goes the 30-day moving average of advanced decline. This is an in-gear situation. Look how beautifully this just kept us on the long side of the market into the end of the year. Very good. So anyway, and we can see this little bit of a distributional structure in the RSI from an overbought condition where it touched 80. Wow, impressive. Now it's starting to try to turn down on the 30-day AD. Okay, so that's a cool tool you may want to consider looking at. And here is the New York advanced decline. Won't say much more about it. All the same rules apply. It's just we're applying it to the New York composite here instead of to the, and you could look at this compared to the S&P too. But I like to look at the New York composite compared to the New York advanced decline. And you can see the directionality and how well it's working here. And now we're starting to turn down. We want to keep an eye to see if this downturn continues, and this has a characteristic of a top in the RSI. Now let's go to the 10-day, much more sensitive indicator. This is through January 3rd, midday today, and you can see a downward stride now in the advanced decline 10-day moving average coinciding with the downward stride in the index. And I would like to make a point which I made prior in a prior episode or more, is that look at the very quick advance of up volume. So this is the advancing volume of advancing shares over a 10-day period. This is a very, very high move. I think that this very strong up volume upward stride is a sign of selling into the end of the year by the composite operator types that are using the strength in the market to raise cash. And so you can also see that this is confirmed by the rising down volume in red. So that also says that these same smart CO types are selling their stocks on a downward stride, or the ones that are in advanced, they're the decliners in this indicator, and they are selling aggressively in December, these stocks also. Now both of these are trending down. Look at the net number. This is just netting the red and the blue line together, and this has been diverging from higher prices in this index since late November. So this shows distribution taking place, non-confirmation of the upward stride, despite the fact that this up volume is pretty strong, downward stride in the net volume to the upward stride in the index. Interesting. Looking now at the 50-day moving average for both the NASDAQ and the New York composite, the only thing I'm going to say here is, and you already can see this, we look for divergent characteristics, we look for oversold, divergences, and then upward stride to confirm the upward trend, overbought, divergent characteristics with to coincide with a top and a downward trend. And we've been using this all year for years now, but we've been using this all year with great success and talking about it here in Power Charting. I know that you all are keeping track of this on your own now, but we do have new people that come along. We want them to know how to do this. I want to show you how to do this. I don't want to do it for you. And so just look at how great these have worked and how well they kept us on the right side of the market all the way through the year. So that's fantastic. And now here's the New York Composite. Same principles apply. Divergent characteristics at an oversold condition. Look at this sub 15% here, sub 20% here. That's the percentage of stocks that are above their 50-day. Oversold, deeply oversold. And then look at how this coincides with important lows in the market. We look for positive divergence internally in these indicators because they tell us that there's a repair and improvement taking place from an oversold condition while the indexes are still going down. So this is, and this tells us, get to work finding the stocks that are starting to move up against the downward trend in the indexes. And so this is telling us, get to work looking for these good ideas. Overbought at the tops coincides so well with the overbought conditions in the market. When this starts to turn down from overbought plus 80% in all these cases and turns down, we want to be cautious. We want to be low to the ground. We want to be defensive, especially for traders. For investors, we might want to make little adjustments in our portfolio to take less risk at these high risk junctures. Such a good tool. Okay, now here's the New York 10-day AD oscillator, the index, and so on, pointing out that we had high and rising volume into mid-December as we would expect, prices are rising. But starting in late November, we have rising down volume also. And this combined gives us a non-confirmation of the upward stride of the market. Market's going up into year end, but underneath the surface, we can see the elements of distribution from the really smart money using the strength in the market to raise cash while the window dressing effect is taking place into year end, because so many institutions don't want to sell their big winners till they get to the new year. And as we saw from the heat map, they're going to pay, I believe, a price for this in the first part of January, is the fact that they wanted to wait to take profits and raise some cash. Okay, so here is this. The only other thing that I have on this indicator is I have the net new highs. So this is new highs minus new lows. Note the fact that we have divergences, lower highs throughout December as the index is going up. Very important divergent characteristic. And so we now would draw a trend line under here to see if we get a break in this upward stride in the New York Composite. Now, here, let's get in. We're almost done here, so stick with me. This is the National Association of Active Investment Managers. This is their net exposure. We have talked about this indicator a number of times. Back in mid-22, we showed how defensive they were. These are active investment managers. They're timers. They're generally very good at what they do. They are trend followers. And here you can see that they were very defensive, very low exposure to the market at the lows in 22 as this base was being built. But they did start to put capital to work. But now let's look at the week-to-week data. This is a 13-week moving average. But look at just the weekly data, and I put little yellow obelisks here where the peak was, and you don't get much above 100 on this indicator, and they got back in this rally from October on. They got back to a very, very exposed position into the end of the year. They are fully back invested in their portfolios. This is a measure of optimism among this group. Now, they are timers, they are trend followers, so I expect them to become defensive if the market turns down, but they took a very strong bullish position into the end of the year. So that is something for us to note. This indicator here, I think, is so interesting. You've seen this many times before. This is the upward stride of the mega bull market starting in 2009, 2010, drawing this trend channel. Look at how beautiful it is. Here at the end of 22, and we showed you this at the time, said the NASDAQ needs to hold these lows here and hold this stride of this demand line. It did just that, finished its basing structure, had a really tremendous advance up into the highs. And look here, look at how we are right at overbought. So very much right at the overbought trend line. And this is, in my mind, a place to be very cautious, a place of vulnerability. And this could lead to just a short-term reaction. It's at resistance up here. It could lead to something more and come back down to the bottom of the channel. At this point, all we know is this is not a low-risk market. This is a great rate of change indicator. I've explained in the past how I construct these. It's a little unique, but you can see we're getting up towards overbought here. And also that the sentiment, which had gone to pessimism in early October as the quarter ended, is now striding back down towards optimism. Now, it's not all the way down there, but it doesn't need to get there, as it was the case here. So we're in a position where this market can no longer be called low risk. And so now let's look ahead to conclude this episode at the election year seasonality. And just to remind you how we do this is I take only, in this case, the election years going back to 1949. This is presidential elections, and we sum them together thanks to Seasonality allowing us to use their tool. They're great people. Go check out their great tool. And you can see that what we have, and this works so well for us in 2023. But here, just to point out that we have sideways in January, February, and this may coincide with down for the mega caps because the mega caps are so overpriced, so overowned. They may actually have a downward stride in them, maybe less so in some of the other indexes that we work with. We get a March low, end of the quarter. We'll have to see where we'll track this over the course of the quarter to see whether or not it tracks accordingly. And then the part that I find most interesting about this indicator is that we have an upward stride from March to September. So the beginning of the second quarter up to the end of the third quarter. And that very well could be one of the really great opportunities to make returns in 2024. And then positive seasonality into election time. This is the election here. And so keep that in mind. And so you can see here that there is the potential for 2024 to be a year with great opportunity. We will use our Wyckoff and tape reading sense to determine that, and also some of the tools I showed you here today. And now lastly, I just want to show you we've used this chart for years. Again, compliments of Seasonality. Thanks much to the great people there for letting us use this. This is 10-year decennial pattern. Now it goes to 2015, but it doesn't change much. So I'll get this updated at some point, but you'll see it's not going to be much different. But here you can see that 2023 really followed, actually 22 Low mid-year, check, we got that. The beginning of 23, strength into mid-year, check, we got that. Range bound condition with some weakness into October of 23, check, we got that. Now, this shows strength into the end of the year, a little bit of strength in the new year, and then down into the first third to half of the year. A little different from our other seasonality chart, but we have from mid-year, we have an upward stride into the end of the year, very well correlating with the other seasonality election year chart that we just looked at. But note 2025. 2025 is is the best year of the decade from the 10-year decennial. Now, this is at this point we have to watch and confirm with our Wyckoff sense. Let's focus on 2023, which has more of a range-bound trading range kind of a structure to it, and but we can still wend our way through 2024 with our great tools that we have going forward. And with that, thank you so much for being here. Go back and watch that mid-December episode. I also have comments in the episodes in the weeks before that that you might like to look at. And with that, I so much appreciate you being here, watching these episodes. I'm glad to be back. It was good to have a little bit of a break at the end of the year. I'm sure the same for you. And it's time for us to get back to work. And with that, my dear friends, we will see you next time on Power Charting. Take care.